Good morning. My name is Tim Nyland, and I'm the Director of Research here at Pacific Point Advisors. 2024 continues to deliver on strength that surprised markets in 2023. During the first half of 2024, the S&P 500 and the NASDAQ 100 continued to rally, 15.1% and 17.3% respectively. This despite interest rate cut expectations being reduced from 6 rate cuts to start the year to now leaving many on Wall Street wondering if the Fed will start cutting rates in September or forego cutting rates at all in 2024. The artificial intelligence rally further narrowed the market leadership from the Magnificent Seven stocks down to Q1 2024's Fabulous Four stocks, down to a single technology stock in Q2 2024, driving the direction of the market on a daily basis. The narrowing performance concentration found its foothold in 2023, with 7 stocks contributing 65% of the S&P 500 performance in calendar year 2023. Among the top 7 stocks, the performance concentration continued to accelerate through the first half of 2024, with a single technology stock, NVIDIA, contributing 30% of the S&P 500 performance through Q2 of 2024. As market leadership continues to narrow, we've suggested investors view the first half performance of 2024 as largely momentum-driven, resulting in large valuation dispersions, driving investors to passively and in many cases unknowingly forego diversification in favor of portfolio concentration and near record levels of portfolio risk. The momentum-driven first half of 2024 market leadership can be illustrated with the following performance contribution chart of the Fabulous Four stocks to the performance of the S&P 500 and the equal-weighted S&P 500. You will note that 7.7% of the first half of 2024's S&P 500 performance of 15.1% is concentrated in the Fabulous Four stocks, while the remaining 496 stocks in the S&P 500 only contributed 7.3%. The equal-weighted S&P 500 performance of only 4.8% for the first half of 2024 is further evidence of the performance concentration in the S&P 500, driven by a handful of mega-cap names. During this same period, the stable earnings core portfolio, illustrated by the blue bar on the far right, posted a well-diversified return of 8.7%. While today's consensus remains focused on the performance of the Magnificent Seven, with an emphasis on the Fabulous Four, no sound financial theory suggests that even 4 or 7 stocks constitute a well-diversified portfolio as a core equity allocation for building and preserving wealth. As investors rush into the Magnificent Seven and Fabulous Four stocks, these fund flows increase the level of concentration in the market and further increases the risk and volatility associated with passive index investing. This can be illustrated by the following 60-year chart, with each bar representing the concentration of the top 5 names in the S&P 500 annually as a percentage of the total market capitalization of the S&P 500. The increase in risk and volatility associated with passive index investing is evidenced by the fact that a single buy or sell order for an S&P 500 ETF indiscriminately executes 500 individual stock trades in proportion to their individual market cap weights in the index. During periods of market volatility, fund flows in and out of these concentrated positions can become detached from the underlying fundamentals and can be exacerbated by nothing more than their enormous weights in the broader market indices. These fund flows inherently raise risk levels for both investors in index ETFs as well as investors in the underlying stocks concentrated in the broader market indices. To protect your portfolio against a sharp drop in one or more of the market leaders, we recommend investing in a well-diversified core equity allocation of quality growth and quality defensive stocks that, in aggregate, exhibit superior capital efficiency and earning stability throughout any economic environment. Our stable earnings core equity portfolios continue to provide this diversification. You see, stable earnings portfolios are not momentum strategies making concentrated market timing bets on technology stocks. The stable earnings portfolios are managed to help investors achieve attractive equity market returns over the long term with significantly lower overall volatility, drawdown, and subsequently lower overall risk. Stable earnings portfolios offer superior risk-adjusted returns over the long term without the concentration risk and associated volatility of the information technology sector or the likes of the Magnificent Seven or the Fabulous Four stocks. From inception on January 6th of 2022 through Q2 of 2024, our stable earnings core portfolio, the blue line, experienced a cumulative net total return of 17.4%, while the S&P 500, the black line, returned 19.4%, and the equal weighted S&P 500, the red line, returned 5.1%. Just as no one could predict when the 1999-2000 dot-com bubble would burst, no one today can predict exactly when the next recession will occur or when the Fabulous Four will swing back to equilibrium. But it's exactly that uncertainty that calls for the peace of mind of the Pacific Point stable earnings portfolios can offer you when they are at the core of your equity allocation. And today, we're moving into Q3 of 2024 with relative valuations for our stable earnings portfolio that are each more than -2 standard deviations below their 10-year average PE relative to the S&P 500. Stated differently, the current price to earnings ratio of each of the 3 stable earnings portfolios are currently at their lowest levels in the past decade compared to the S&P 500. You will want to recall that a significant portion of this divergence is due to the rush into the Magnificent Seven technology stocks. We believe current valuations offer an attractive entry point for new allocations into the stable earnings family of core equity portfolios. Thank you for your continued confidence in Pacific Point.